is about depreciations, and we have several types of depreciation. So let's go one by one, see what's in the book. And if you have any question, ask me. Otherwise, I try to explain as much as I can, okay? We already learned in bookkeeping that how to record the depreciation, right? So in order to record the depreciation, we need to record depreciation expense as a debit and accumulated depreciation as credit. Accumulated depreciation, it's keeping the track of how much has been depreciated so far, and it will be reflected in the balance sheet. Okay, there is an example here. Let's read that, see if we need to explain something. In 2017, Foucault computes annual depreciation using GAAP rule at $40,000 and compute depreciation using tax rules at $50,000. The adjusting journal entry recorded in the general ledger on December 31st use only the GAAP amount, which is $40,000. The $50,000 depreciation expense deducted on the tax return is not recorded in the general ledger. So sometimes the way that you use depreciation is not same as exactly the way you depreciate in the tax. Because for tax, we have specific provided options. We have to follow those. For GAAP, you might have different options available to you, let's say based on, let's say, number of machine hours that you use, or number of mileage that you drove for your truck. Based on the output, you might depreciate it straight line method. Maybe you depreciate it double declining method. So for tax, if you have to see what type of equipment it is, and the IRS will provide you a specific options to depreciate for the tax purposes. However, for tax purposes, normally the straight line is also available, and most of the time you can use the straight line option and depreciate your book as following GAAP under straight line depreciation, and also use the same straight line depreciation in tax, and literally have the same results on both sides of the tax return and bookkeeping. Straight line depreciation, we will learn probably down the road in next few pages, but then we will talk about it. Okay, so depreciation under GAAP. It says, generally, a company that is preparing financial statements under GAAP for a third party must have a CPA who is independent, go over the statements to ensure that statements are properly prepared. The CPA will perform one of the three services, either a compilation, a review, or an audit. A compilation, that means you are compiling. The independent CPA organizes, compiling, the company's financial data into various financial statements, usually following industry format, but does not express an opinion on the reliability or accuracy of the statements, or whether they conform to GAAP in any shape or form. In fact, CPA often put together financial statements for the company using whatever facts and figures the company has provided. So the CPA just relies on the company. Whatever the company provided, CPA put it together, including tax depreciation, and add a note stating that the statements are based only on the information provided by the company. So that's just a compilation. A review is the independent CPA provides a report describing his or her limited inspection, that's the word, limited inspection of the financial statements, and stating that he or she did not find any material or significant difference between those data and GAAP rules. However, the audit is the strongest one. The independent CPA examines the company's financial statements and express an opinion on whether the materiality, whether the data materially conforms with the GAAP rules and the materials are reliable because the CPA went through the data and journal entries and examined those journal entries, not all of them, but to some degree, as a form of samples, and then he provides an audit. So materiality is very important in accounting, because if something is not material, then you don't need to be worried about it. You don't need to spend time on it. Tax depreciation rules are based on many of the same concepts as GAAP depreciation rules. Like, as I said, like straight line method is available. Double declining balance depreciation method, it's also available under tax and under GAAP. Consequently, the difference between the two calculations is often not material. If a company can use tax depreciation for both tax and book purposes, it can avoid having a record one amount in the general ledger and another amount in the tax return. A CPA doing a review or audit usually must use GAAP, right? That's how you follow the bookkeeping rules for the financial statements. However, it can use tax depreciation for its financial statements if the difference between tax depreciation and GAAP depreciation is not material. And if you do, let's say, straight line method, it will be literally same. If you use a double declining method, again, it will be almost same. So it's going to be okay. But if you use, let's say, percentage of output, like how many miles driven a year or how many machine hours has been used a year to calculate the depreciation, then it might be different, because one year maybe the business has very little activity, so the depreciation will be less, and the next year has high activity, then the depreciation all of a sudden will go high when you are using GAAP rule under unit of activity depreciation method. Okay, so what is this example tool? Let's look at that. In 2015, BACO calculates tax depreciation at $50,000 and book depreciation under GAAP at $52,000. If the CPA determines that the $2,000 difference is not material, depreciation will be presented on the reviewed or audited statement as at $50,000, which are if they decide $2,000 is not material. And the $2,000 materiality comes from the company. It depends how big company are and how much revenue and expenses are existing in the financial statements. So in summary, it says the purpose of depreciation expense is to match an asset's cost with the revenue that it helps the company earn in the same period. So this is a matching principle issue. Matching principle says whatever revenue you have for the year, you need to match it with your expenses that has been incurred to generate that revenue. Okay, so you can do some problems here, quiz, and look at the answers for feedback. Section 2 is talking about depreciation under GAAP for book purposes. Probably you know this by now, but it's a good review anyway for us, right? So let's look at this example so we can have the talking point. It says for Kuko purchases a machine that has the following breakdown of cost: invoice price plus sales tax plus freight for shipping, outside contractor to install the machine. Yes. So you have to add all this stuff that you spend to have the equipment ready for intended use. For depreciation purpose, the cost of machine ends up to be $22,200 in the T account. And you add up all those costs. Now the machine is ready for intended use, and your T account will be updated with $22,200. And this is the journal entry. Asset, like equipment dash machine, will be debited to increase the asset, and cash will be, let's say, paid to purchase the equipment. Okay, but sometimes we have a group purchase. So this is a good example, possibly. If it's a group basket purchase, then you need to calculate, because when you buy in a basket, so you probably pay less than if you pay individually for each item. So you need to kind of fairly distribute and recognize the value of each asset that you purchased. So let's look at this example. Says the company purchase of a computer, printer, and a copier has an acquisition cost of $6,000. The invoice does not separately list the cost of each item, which is okay. So it looks like they bought a basket of few items. What is the acquisition cost of each asset? So now you have to look at the fair market value, using appraisal, using outside sources for fair market value. So if you look at the outside sources or some type of appraisal, you see that computer worth about $4,000, printer is about $1,000, copier is about $3,000. So you are looking at $8,000 fair market value. So what is the assets portion of the total of 6,000? So every single asset, you need to see what portion of it will be coming out of this $6,000 to go into the T account. So computer has a $4,000 fair market value, and out of total $8,000 total fair market value, we are looking at 50% rate. So 50% rate times $6,000 basket purchase, that ends up to be $3,000 going into the T account for computer. For printer, the fair market value is $1,000 out of total fair market value of $8,000. That gives us a rate of 0.125 times $6,000 purchase in a basket gives us $750 that needs to be recognized in the printer T account for the equipment. And we have also copier, another machine. $3,000 is the fair market value of the machine out of $8,000 total fair market value, gives us 0.375. That's the percentage, times $6,000 basket purchase, and $2,250 needs to go to towards the copier. So at this point, now we can easily assign a cost in this basket purchase for each item, right? Very easy. So computer now has to be recognized for $3,000. Printer needs to be recognized for $750. Copier needs to recognize for $2,250. And the cost will be exactly the $6,000 that we paid. Okay. Let's look at this bottom. It says contributed asset. It's common practice in startup and even in established companies for owners to contribute asset rather than cash in exchange for stock. The computation and journal entries for contributed assets under GAAP or tax rules are done by a CPA and are not included in this course. So this situation depends on several factors. So it's out of like area for this book, and depends what type of business it is. It depends if it's a corporation, if it's a partnership. So there are several factors that needs to be considered. So that will be in advanced accounting type of books. Estimated life needs to be estimated as we are talking about, but under tax purpose, the tax will tell you what type of life you're gonna use for tax purposes. So you might want to look at your equipment to see what type of useful life you're gonna use in your tax purposes, and use the same thing in your bookkeeping, so you can have kind of, you know, the same depreciation as you go forward. The estimated life is the number of years the company expects the asset to last, or the amount of production it expects from the machine, measured in the hours, miles, unit produced, or any other standards. For example, a machine's life may be measured in years of expected use or units of expected production. Expected production rate, it's good in GAAP, but we don't have anything like this expected production under tax. An automobile in years or miles or hours of expected use, a building in years of expected use. Yes, so building is expected use, let's say for tax purposes. If it's a residential building, it's 27.5 years. If it is commercial building, it's 39 years, straight line. But for automobile, you just use whatever the tax is offering you. It's easier. I believe it's about 5 years, and that's a good way to go. But if you start using mileage, then there is no such a thing in tax. And if you use mileage, then 1 year you drive more, 1 year you drive less, and your depreciation expense will be totally different than tax. Okay, what is residual value? As you remember in your bookkeeping classes, residual value is the total cost of the equipment minus the value, the salvage value of the equipment that you can sell after useful life. Let's say you purchased an equipment for $10,000, but after 5 years, you might be able to sell it for $1,500. So that $1,500 possible estimated market selling price after 5 years of useful life, that is your residual value, or so-called salvage value. So if you deduct residual value from acquisition cost of your equipment, then you get the depreciable base, or depreciable amount, or depreciable value. And then you divide the depreciable base, let's say under straight line method, divided by useful life, and you get the annual depreciation. So in order to calculate annual depreciation amount, you always need residual value at the beginning of calculation to get the depreciable base. However, remember this, the only method that you do not need residual value at the beginning of your calculation is balance declining method. So for balance declining method, you do not need residual value at the beginning of your calculation, but you need the residual value at the end of useful life, because at the last year of useful life, you probably need to be very careful to not depreciate too much, because you cannot go below the residual value. You might say the residual value is 0. That's fine. If the residual value is 0, which I like that because it creates a lot of easy calculation, then technically under balance declining method, you don't use residual value in the calculation whatsoever, not in the beginning, and you don't need to be worried at the end anyway. For balance declining method, we have several ways of using balance declining method. You might use double declining method. You can use 150% declining method. You can use 125% declining method. So those are options that are available even under tax, but double declining is very common, and you have the same thing under tax, and you have the same thing under GAAP. So here at the end of the page 16 is talking about straight line method, which we already talked about it. Straight line method is total cost minus residual value gives you depreciable base. Depreciable base divided by useful life gives you straight line method calculation. Okay. So if I want to write it here, is cost minus residual value divided by useful life. That's straight line. Gives you annual depreciation amount. Okay, for the next page, on page 17, is talking about the units of production or units of output. That depends on the what you want to use. You in this method, you say, okay, I want cost minus residual value. You see, every time I'm using residual value again, and divided by number of output. That output can be mileage, can be machine hours, can be units. Let's say if it's like a specific type of machine that does production or something. And that gives you depreciation per output. Depreciation per output. However, this method might be 1 year very large amount, 1 year small amount, because it depends how many units of output you are using, how many miles you are driving, or how many machine hours you are using it. So some years might be high, and this doesn't exist in tax. So it's totally can be too much, too little, and cannot match with tax. But straight line is an option available for tax purposes. Accelerated method, that's the balance declining method. And normally double declining balance method is the common one. So there are two methods of accelerated depreciation. They are called accelerated because they provide more annual depreciation expense in the earlier years of the asset life and less depreciation expense in the later years. The two accelerated methods are declining balance, like double declining method, and the sum of the years digit. Sum of the years digit is not that much popular, but that's it. That's what it is. That's a method that it's right there. For GAAP purposes, those are all GAAP, which are explained in the course in section 5 and 6 separately. Okay, on how depreciation is recorded. Yes, so we know that already, right? In order to do the journal entry, you always debit the depreciation expense and you accumulate your amount of depreciation in an account. We call it accumulated depreciation. And the accumulated depreciation always is showing us how much has been depreciated so far for the last year or last 2 years or last 10 years, how it depends, right? Accumulated depreciation is a contra account to asset. So you have your asset less accumulated depreciation gives you net asset. And here is at the bottom is explaining about expense. So yes, the depreciation expense goes in the income statement, obviously, and accumulated depreciation goes in the balance sheet, right below equipment that you have. So accumulated depreciation, it's a contra account to your asset. So here is a good example of a chart of account. Let's say we have different property, plant, and equipment, PP&E. We have office building, we have garage, we have warehouse. So they are categorized in one category, and then we have accumulated depreciation dash building. That makes sense. And then we have another set of assets like truck, automobile, and forklift. And then we created an accumulated depreciation dash vehicles for these three to be recorded in this contra account. So those are all PP&E, property, plant, and equipment here. PP&E. And here we have another one. Let's say computers and drill press and printer, let's say. Those are going into, let's say, office equipment. So you call it accumulated depreciation dash equipment or dash office equipment. Good. Let's look at an example here. Says on January 3rd of 2005, Hako purchases a computer for $10,000 cash, then takes $1,000 depreciation in 2015, a year of purchase, and $1,000 in 2016. Okay, in which accounts does Hako record the acquisition, 2015 depreciation expense, and 2016 depreciation expense? So in January 3rd, let's say, they record the asset dash computer, $10,000 debit. So asset will increase and cash will be credited to decrease cash to show the payment. At the end of the year, so we don't have any expense, as you see here. We capitalize the asset, as you see. So we capitalize the asset in order to depreciate it at the end of the period. So end of the period, end of the year in this case, we record the depreciation expense of this capitalized asset, and we credit accumulated depreciation dash equipment to have a record of how much has been depreciated so far. So at the end of year one, the net asset is asset less accumulated depreciation. So 10,000 less 1,000, the net book value of the asset is 9,000. At this point, if you sell the asset, anything above 9,000 will be a gain on sale of equipment. If you sell the equipment for anything below 9,000 at the end of the year, then you will have a loss on sale of equipment for whatever you sold below 9,000. In year two, you need to recognize again one more time depreciation expense that belongs to year two for $1,000 one more time, straight line method, and accumulated depreciation equipment, again, $1,000, same thing. So if you notice, we purchased this equipment right in January, so we don't need to be worried about how many months we use it. Looks like we use it for 12 months, so you don't need to be worried at the year one how many months has been used. So after the recording of year two depreciation, the accumulated depreciation for equipment ends up to be $2,000, which is $1,000 from year one and $1,000 from year two. So the book value at the end of year two will be what? The book value at the end of year two will be 8,000, which is 10,000 original total cost minus $2,000 accumulated depreciation. So let's look at this one. This might be interesting. Manufacturing companies record depreciation in two ways. Depreciation for machine, building, or other fixed asset used in the manufacture of product is recorded in the inventory account, not in depreciation expense as follows. So if you took managerial accounting, maybe you know this already, but if you haven't, then we have two types of things to depreciate. If you have office and you have also factory to manufacture some products, so anything in the office will be depreciated as depreciation expense debit, like that here. Depreciation expense debit, accumulated depreciation dash office equipment credit. That's in your office. But because you have a factory also, in the factory, you have also equipment that you need to depreciate. Anything in the factory that you are depreciating, that will not be recorded as depreciation expense in any shape or form. So then what do you debit then if you don't debit depreciation expense? In the factory, anything that you cannot trace it as a straight line easily, trace it easily to the product will go in the overhead. In order to create a product, any product, you need three things. You need direct material, agree? You need direct labor to make that product for you. And you need a place to make the product, right? One more time. To make a product, you need direct material, you need direct labor, and you need a space to make the product. The space that you make the product is the factory, and we call it factory overhead or manufacturing overhead. So manufacturing overhead is anything that we cannot trace it. Look at this pen. What is in this pen? It's some plastic, some metal, which is direct material, and someone made it, which is direct labor. But can I trace the factory rent into this pen? Not specifically, right? I can specifically say how much material it has, how much labor it needs, but I cannot specifically say where the factory rent is going. So I put the factory rent in the overhead. I put the factory insurance expense in the overhead. I put utility expense in the overhead. So we don't have utility expense, insurance expense, rent expense, depreciation expense in the manufacturing calculation. In the manufacturing area, we put all those extra expenses that cannot be easily traced into the product, into the final product, will go into the overhead. So one of those things that goes into overhead is next to rent expense, utility expense, insurance expense. It is the depreciation, which goes into the overhead. Okay. The journal entry here is almost okay. It's because we have to do one more journal entry before we do this, but that's fine. That's easy, good enough for now, so you know. But in order to know exact journal entry, you have to take the managerial accounting, which I don't want to go there for now. Make sense? Any questions so far? Okay, so let's keep going. So let's look at this example. Here it says, when assets are used for both manufacturing and non-manufacturing purpose, such as building that holds both administrative and production facilities, or an air conditioning system that cools both production and office space, depreciation is allocated proportionally, like using square footage, let's say, between inventory and depreciation expense as follows. So the inventory, the work in process that where you produce the product, will be increased. So the cost of inventory will increase because of that depreciation expense. And the depreciation expense will be recognized for the administrative expense calculation, for operating expense calculation. So I might have something to show you from the managerial accounting, which might help you to understand it. Yes, this one. So let me show you quickly this one so you can kind of see the idea. So you see manufacturing overhead, the depreciation expense, eventually when you sell the product, you will see that ends up to be in the cost of goods sold. Cost of, let's say you are producing this pen, right? And this is the pen that you are selling. So when you sold this pen, the cost of goods sold will be recognized, which is including direct material, direct labor, and overhead, right? But now look at a little bit lower, look at where the depreciation expense for office goes. Depreciation expense for the office will be part of operating expense below gross profit, right? Below gross profit, in the operating expense, we have two categories. We have selling expense, let's say showroom equipment depreciation, and we have office equipment depreciation, which goes in the general administrative expense. So those are period costs that will be calculated as part of operating expenses, equipment depreciation for showroom, and equipment depreciation for office. Those will be in here. Has nothing to do with manufacturing overhead. But equipment depreciation for the factory will be recognized as manufacturing overhead. You never tell or recognize it as depreciation expense. Yes, I know it's a depreciation expense, but you debit overhead. You don't debit depreciation expense. But here, for this equipment in this area, yes, you debit depreciation expense. Any question? Okay. I'm trying to see. Let's look at this example before we move on. So it says the company manufactures allocates $10,000 of depreciation as follows: $2,000 for manufacturing machinery and $8,000 for building. Seiko determines that 75% of building is used for manufacturing. What adjusting entry does Seiko record at the year end to recognize the depreciation? So Seiko must compute how much of the $8,000 depreciation for the building to allocate to manufacturing versus office use. So to compute $8,000 building depreciation times 75%, that's the manufacturing use, equals $6,000 of depreciation allocated to the manufacturing. The remaining $2,000 will be recorded as so-called depreciation expense for the office depreciation expense, right? So for office area, for general administrative area. So $8,000 building depreciation times 25%, that's 2,000. So to journalize that, you record for office area, general administrative expense, operating expense area that I was showing in the income statement. You record depreciation expense $2,000 debit, accumulated depreciation credit. This is for office use. However, the portion that will go to be recognized for the manufacturing area, you debit overhead for $8,000. You credit accumulated depreciation dash equipment for the manufacturing area and accumulated depreciation dash building for the manufacturing area again. And that's based on the percentage of use that you use the building. So for the building, you use $6,000 for manufacturing and $2,000 for office area. So if you look here, it says in the balance sheet, when you have land never depreciates, right? So you don't need to have anything else next to land. So land is here and that's it. 75,000 is gonna stay in your balance sheet forever as $75,000. But the building, you need to show the cost on the left column. You need to show cost, and then you deduct the accumulated depreciation for the building as of that date, which is, let's say, 100,000. And then you put the net building next below the land, and then you add those together, then you show the total property, plant, and equipment 975. Make sense? So in this example, again, it's a very good one. So the same scenario, we have land, which you don't need to do anything. You go all the way to the right column. But we have building, which you go to the left column to calculate the net building. which is 900 on the right column. And then you have also equipment. Again, you go to the left column, you just calculate the net equipment, and the net equipment of 20,600 goes to the right column. And then you add them up, and that will be your total PP&E. So far, so good? Okay. So there are some quizzes for you to practice a little bit and get the feedback. In section 3, we are talking about straight line method of depreciation, which should be very easy section, I believe. So we talked about it. What is depreciable base? Depreciable base is a original total cost, including shipping, sales tax, installation, minus residual value, gives you depreciable base, divided by useful life, estimated useful life, and that gives you annual depreciation expense. Here says there's another way to calculate. You say, okay, 100% of my equipment divided by estimated useful life gives you the depreciation rate. So 100% divided by, let's say 100% divided by 5 years useful life. So 100% divided by 5 years useful life gives you 20% depreciation rate on an annual basis. That's gives you the same information like above. Okay. Simple as that, and you can just read the examples and you can see it. So here is 40,000 depreciable base divided by 5 years estimated life. That gives you $8,000 annual depreciation. Here. And if you want to use the 100% that I said, so 100% divided by, here, 100% divided by 5, it gives you 20% annual depreciation rate. Then you multiply 20% annual depreciation rate under straight line method by $40,000 depreciable base, and you get annual depreciation of $8,000. In problem number 2, looks like you paid for invoice cost of $90,000, some sales tax $7,000, delivery and installation $3,000. So total acquisition cost of the equipment is $100,000, and you believe there is a residual value for this of $10,000. So the depreciable base will be $90,000. And you're gonna use the depreciable base for your calculation. So here, depreciable base, 90,000 divided by 10 years estimated life gives you $9,000 annual depreciation. And if you like to use the 100% method that I said to calculate the depreciation rate, so say just 100% divided by 10 years gives you 10%. 10% times depreciable base of $90,000, and that gives you annual depreciation. One more time, 10% of depreciable base. And depreciable base is 100 minus 10 equals 90K. That's your depreciable base. Okay. And to record it, again, debit depreciation expense, credit accumulated depreciation. In next paragraph is talking about if you purchased an asset sometime in the middle of the year, so you have to then do some a little bit more calculation in year one because you didn't purchase it right at the beginning of January. So here I might have an example. On June 1st of 2007, which has a calendar year purchase equipment with an acquisition cost of $70,000, estimated life 5 years, residual value $10,000. What is the first depreciation, first year depreciation if CRECO prorates first year usage by the number of months the equipment is used? So they bought it in June. So June, July, August, September, October, November, December. It looks like that's 7 months. Right? So 70 minus 10 here, you get the depreciable base, 60,000. Depreciable base divided by 5 years gives you 12,000 annual depreciation expense. However, in year one, you use it just for 7 months out of 12 months. So 7 out of 12, that gives you 7,000 first year depreciation. 7 out of 12 times 12,000 depreciation, annual depreciation gives you first year depreciation. Cool. In order to, at the bottom of the page 34, in order to track, you can create a schedule of depreciation in Excel, and just that way you can see how much you're going to depreciate every year by just looking at your Excel document. So here is an Excel document, and you have the depreciation expense every year for $9,000. And every year you're going to credit to accumulated depreciation for $9,000. So the balance of accumulated depreciation every year will keep going up and up and up until it gets to $90,000. And the book value of the equipment from the beginning, which was $100,000, it keeps going down and down all the way till after 10 years, it will stop the book value at, this is where you stop. Stop the depreciation at 10,000 useful life. You always make sure that you stop at that time and you don't depreciate anymore. Obviously, if you say the residual value will be probably 0, then you stop at 0. If you say residual value is 10,000, then you need to follow that. Are we good so far? Any question, maybe? Someone? Okay. By the way, yesterday was the last day of preparing tax returns in VITA program. We were very busy. We had like at least 26 tax returns yesterday prepared. And we did over 100, barely just passed, I bet at least 100, but I'm guessing counting FSA links that individuals might use it at home to prepare taxes, it would be maybe more than 100, but we definitely prepared 100 tax return. And interestingly, it was exactly 100 tax return that we did physically in our office, but including FSA, it will be more than that. And students, they had a very positive experience, and it was interesting. If you like to take that class, please definitely take it. Next January, maybe starting January 10 or something. But you need to register ahead of time in December, accounting 106A. That is like 6 weeks of training and certification. And then you can start preparing taxes for 8 weeks, taking accounting 108A. 106A is 2 units, 108A is 1 unit. Okay. Okay, let's look at this one. Is interesting because on page 36, it says, how about if you bought it like in the middle of the year and use it for, let's say, just 7 months. So in year 1, your depreciation expense will be only 7 months. That's it. And after that, under straight line will be the same $9,000. So your book value keeps going down, all the way down to stop area at 10, stop. That's the stop at residual value. But in year, this is not year 10 anymore, this is year 11. Why? It's year 11 here, as you see, because in year 1, you just depreciated 7 months. So in year 11, you end up by depreciating for the remaining 5 months of 10 years useful life. So in this case, it's 5 months out of 12 months. In year 11, you just depreciate for 5 months out of 12, and then you stop at $10,000 estimated residual value. So just be careful on that mid-year purchase. And your book is showing like an Excel that you normally create. You call it depreciation schedule. And there's a sample here that you can create for every type of equipment that you have. So you can have a depreciation schedule. And using that schedule every year, you know how much to depreciate. Here is an example of depreciation schedule filled up already on page 40. So you can look at it and see what type of equipment here you have. Let's say here you see you have office building, you have land for office building, you have warehouse, and you have land for warehouse. Land never depreciates, but office building and warehouse will depreciate. And you have the date of purchase and method, sorry, method, sorry, my voice is gone. Method of depreciation that you are using. Let's say for office, you are using straight line. For land, you never use anything, so it's not applicable. For warehouse, again, you use straight line. Rate of useful life is, let's say for building, you say 30. Under tax purposes, it's 39 years for commercial building. You can use 39 if you like. For warehouse is rate of life is 4%. I have to see where is that 4% coming from. I have to read the instructions, but depends on, I don't know, this is just a sample. So depreciable cost is or the basis is $300,000 worth of the like office building. The land has been appraised for $55,000. In order to, another way to, besides regular appraisal, if you look at your tax document, property tax document that you receive at very first year that you purchase your equipment building, it will separate the building cost and land cost in the tax document. You can use that as a reference to do this. Warehouse is $90,000, and land again here will be, has been appraised for $32,000. Residual value for building, they have some dollar amount, let's say $100,000, and for the warehouse is $25,000. Depreciation in previous years already is $40,000 depreciation in prior years, like out of that 300,000 base, 40 is depreciated. For warehouse, that has been depreciation prior years is already 90 out of that 90 depreciable base. So looks like they already depreciate that. So depreciation for year end for building is $10,000. It goes in this Excel, but there is no depreciation for this year for warehouse, looks like, because it has been already depreciated. Accumulated depreciation as of the date, like 2016, now it is $70,000. Accumulated depreciation previous year in 2014 was 50. Accumulated depreciation in 2015 was 60. And accumulated depreciation at the end of 2016 now is 70. So you see, every year the accumulated depreciation is keep going up, 50 to 60, 60 to 70. And prior to 2014, it has been depreciated up to 40,000. And then in 2014, we depreciated 10,000. In 2015, we depreciated another 10,000. Now accumulated depreciation went up. And in 2016, we depreciated another 10,000. So the accumulated depreciation went up again. So as of this moment, accumulated depreciation at the end of 2016 is 70,000, and the depreciable base is $300,000. Stop. Okay. So far, so good. So just look at this as a form of, to see what they are doing, where the company is standing at this moment, what type of assets they have, if they have equipment, are they using straight line or anything else, what is the useful life, and all the detailed information is provided here. When you prepare your taxes, also something like this will be reflected in your company's tax return. So every equipment has been properly shown, something like this, in your tax return of the corporation or the company. Okay. So like here, I see, you see this automobile has been sold. So it says depreciation this year, it has been sold. So there's nothing there. Okay. And here says there are some details about note the following data in page 41. I believe this area is explaining what's going on in this page 40 depreciation schedule, which you can read it to kind of understand what's going on in the page 40. Okay, let's see if I need to. Yeah, even that the same explanation goes in page 42 and 43, I believe. Yeah, so I believe you're from page 40, the worksheet that you have, the next 4 pages are explaining what is going on in this schedule. So I suggest, look at line one line a little bit to see what you see, and then read the information so you can get familiar with this company and what type of depreciations they are doing. It's a good sample. For the next section, section 4, also I want to see if I can. Okay, units of production method of depreciation, that's in section 4. For units of production method, you have to use either mileage, machine hours, units produced, something like that. So there are different options that you can use. This type of depreciation doesn't exist in taxation. So just so you know, it is just available under GAAP. So it says here, depreciable base divided by estimated number of units, miles, hours, whatever it might be. You get the depreciation rate and for every one output, every 1 mile, every 1 unit, every 1 machine hours. And then you multiply that rate by number of hours or machine hours or mileage that you drive in every year. So that might be 1 year very high, 1 year low, next year average. So every year might be totally different. After all those miles, let's say, are driven and you depreciate it, you don't depreciate anymore. You might keep that, let's say, truck for another few years and drive so many miles, but you don't depreciate anymore. So you just depreciate whatever the depreciable base is. You don't depreciate forever. So one example here, it is on January 1st, the company is using the units of production for delivery van that they purchased $10,000. Okay, delivery van purchased $10,000. They believe that they're gonna use this van for, let's say, 200,000 miles. You might say, no, this machine gonna go like 30,000 hours. Or you say, no, we can do 10,000 deliveries. So you have to choose which one you wanna use and go with the best option. I believe mileage is a very good option. So if you want to use mileage, here, $9,000 depreciable base, because the residual value is 1,000, so depreciable base is just $9,000. So 10,000 minus 1,000, 9,000. Now, depreciable base divided by 200,000 miles driven. So every mile will cost like 4.5 cents depreciation rate. And then you just need to know how much you drove every year, multiply that 4.5 cents, and that will be your depreciation expense. Simple as that. Very easy. Any question? So let's look at this problem. Looks also good here. It says in page 63, it says we have equipment, but we paid sales tax, we paid for the shipping, and total acquisition cost ends up to be $23,000. We believe there might be estimated $2,000 residual value, and the depreciable base is $21,000. After you calculate that, we believe this machine will provide us 30,000 units of production, whatever it is producing. So 21,000 depreciable base divided by 30,000 units of production gives us 70 cents per unit depreciation rate. So let's say in year one, you produce 6,200 units. So 6,200 units times 70 cents rate of depreciation, then you need to recognize $4,040 for depreciation. And that will be the depreciation expense debit, accumulated depreciation credit for the equipment. In year two might be totally different because let's say you produce only 5,800 units. So again, times the same depreciation rate, and you do the journal entry again. All you need to know to make sure that 6,200 plus 5,800 is not passing the total 30,000 unit. So 62 plus 58 is 0, 0, 0, 2. So far it looks like 12,000 units. Okay. And 12,000 units minus the 30. So still you have, let's say 18,000 units left to use for the calculation of depreciation. So make sure you do not go over 30,000 units and keep depreciating forever. Make sense? You can keep the equipment forever, but you cannot depreciate it forever. Okay, so in this area, looks like we purchased the on page 65, we purchased the equipment starting June, looks like, in the middle of the year. And we have different outputs here. In year one, unit of produced, and in year 7 through 11, unit produced. So you see there are different units produced, so you have to know what is the unit depreciation rate. It says $100,000 acquisition cost minus 10,000 residual value, so that gives you 90,000 depreciable base, right? 90,000 depreciable base divided by 2 million units of production, it gives you 4.5 cents depreciation rate for each unit of production. And here it provides you all the production of year 1 through year 11. And here is the solution. So you have a schedule that every year you update it. You say, okay, in year by end of first year, we produced 123,000 units in that 6 months. So you see, there is no specific issue in regards to when did you buy it. Is it in July or August? Doesn't matter, because you go with the units of production. So units of production times the depreciation rate gives you the dollar amount that you need to depreciate. Doesn't matter you bought it in June or July or August. That doesn't matter. So easily just multiply with the units of production and you get your depreciation expense. All you need to do is this part. The book value, that's where you stop the depreciation. Why? Because let's say here you produced in year 11, you produced maybe more than 87,000 units, maybe like 100,000 units. That doesn't matter. Maybe you produced 300,000 units. Doesn't matter. All you need to do is just to depreciate to make sure from 13,915 you go to 10,000 year-end book value and you stop. So in order to go to that, all you can depreciate is 3,950. Even though you might say, oh, I produced 187,000. Doesn't matter. You can say 187,000 times 45 cents, but that doesn't matter. All you can depreciate in last year, just make sure you know where to stop. That's the tricky part. Other than that, it's easy. Are we good? Okay. Again, it gives you a blank copy. It gives you a sample of filled up schedule of depreciation on page 68 and 69. Same thing in here. There are some examples again explaining what's in this schedule of depreciation. And this is good just for study. Oh, this one is good. Revising the estimated life. Yes, you can revise the estimated life. It's not unusual for a company to discover that it has made an incorrect estimate of an asset's life or residual value. When this occurs, the company can revise the estimated life or the residual value and compute the new annual depreciation expense prospectively. Prospectively means you go forward. You don't say, oh, because I made a mistake, let me go back to year 1, 2, 3. No, you don't go back. You don't go retrospectively back. You go prospectively forward. And from that point on, you calculate the new depreciation for the remaining useful life in future. Cool? And that's it. And then you have some quiz to practice on this. Any question for me, please?
I have one quick question.
Yes.
So if a company is depreciating every year, that helps their balance sheet, correct? It would help them to have less of a profit and less taxes. And then when it ends, they can no longer depreciate, but then they continue to make the products. So then how does that affect the balance sheet? I mean, how does it affect the profit, I guess I would say?
Yeah, profit. That's a good thing because depreciation has or is a non-cash expense. So when you buy an equipment, instead of calling $100,000 equipment expense, you capitalize it and you match the depreciation expense based for the next 10 years, let's say, with your production of revenue. And you deduct depreciation expense from your actual income, and you will have less taxable income and you will pay less taxes. But after 10 years useful life, you keep the equipment if you like for another 5 years or whatever, and you will have no more the luxury of having non-cash depreciation expense to reduce your taxable income. In that case, your income will be higher.
Right.
And you end up by paying a little bit more income tax because of higher income. But if you look at the positive side of it, is your shareholders, your investors, or possible future creditors, they will see that you have the equipment, you're still using it, it's already depreciated, but still is generating profit, and your income is becoming now going higher and higher and higher every year, which provides some good sign, right? Like I had a business, small business, and I had few expensive equipments, which those depreciation expense recognized year after year put my company in deficit retained earning. So if someone was looking at my balance sheet, they see that my retained earning is showing a negative number. That doesn't mean for last 5 years I was not making money. No, I was making money for last 5 years, but because my depreciation expense was so high, so constantly that high non-cash depreciation expense was pushing my retained earning to the deficit side instead of credit side, which is showing positive retained earning.
Okay, and that's why people who invest in real estate, like rental, that have rental income, they they are still getting like their, say, $1,000 a month for rent, but they're not paying taxes on $1,000 a month. They're paying taxes on less their expenses and whatever the depreciation is in there. Yes. So like, let's say their depreciation is $500. They're still, having $1,000 of income, but they're only paying taxes on $500. Is that right?
Yeah.
Okay.
And if it's a residential property, you depreciate it for 27 and a half years straight line method. If it's a commercial property, you depreciate it straight line 39 years under tax.
I see. Okay.
Which is good, but after 27 and a half years, if you are still renting that property, not only your rent will be higher, rent income, because after 27 and a half years, probably now you are renting it for $2,000.
Right.
But you don't have anything to depreciate anymore because it has been already depreciated for last 27 and a half years. Then you have all of a sudden $2,000 rent income, and you have to pay taxes for that, obviously.
Okay, thanks. I get it.
Yeah. Anyway, that was section 1 through 4, which is, I believe it is easy so far, nothing complicated. Just read the material and look at, those examples and try some quizzes. I suggest as you read this, go ahead to the end of the book and answer those questions for the final exam. Okay.